Hello, everyone.
Hello. Hey.
Hello.
Hi, Penelope. What do we need to do? Should we try the screen share, or what do you suggest?
Hello. Sorry. Yes, I think it's just if you can test the screen share. If you weren't able to test it at our test session on Monday. So I'm not sure who hasn't been able to have a chance. I think, Kenneth, you were in and it went fine for you. Is that correct?
Sorry, Penelope, I didn't hear you. What was that?
Can you hear me? Am I too soft?
I can hear you, yeah.
Okay, good. Okay, just to say, were you able to share on Monday during our test session?
I did not, but I managed to reorient my screen and the pixelation was tested. So that was what we did. I didn't share anything on Monday.
Firo, I understand you've tested already and you're fine. Abdul, have you had a chance?
Hello, everyone. Can you hear me? Yeah.
Yes, nice.
It's clear.
Do you want to test the sharing of your presentation?
Okay. Come on, please. Let me try it. It is working. Is it working for you?
Yes, working.
It's working perfectly. Thank you.
Okay, thank you.
Okay. Kandalem, do you want to test your presentation? I'm not sure.
You see?
That's great. Thank you. Okay. I think we're all ready then.
Mm-hmm.
Good morning, Professor Petros. Lovely to see you today.
Hi, good afternoon from Ethiopia.
Good afternoon.
Okay, pleased to meet you.
Thank you, and you. We'll begin in a few minutes.
Okay.
Are you planning to use a presentation or are you just speaking to us?
I'm just speaking to you.
Perfect. Then we've tested and it's working. Thank you.
Okay. በመካከሉ አንዳንድ ግልች ቢያጋጥም ያው እዚህ ሰፈር አላችሁ አሁን ምንድን ነው ኦኬ የሰው ስም ነው በቃ ስምል
Okay. So, okay. ወደ እኔ የመጣ ነገር የለም። ይቻላል። እኔ እንጠይቃታለን ወይ አናግራት ይችላል።
Hi, Stephanie. Welcome.
Hi, Penelope. Thanks. So no connection problems here.
Wonderful. Thank you. We'll be starting in a few minutes.
Okay.
Thank you.
sometimes ወደ 2G ትቀይራለች አሁን Hello, Das. Isama? Is there it? Yeah. Nah, any other as
Good morning, good afternoon, and good evening, everyone. We're about to begin a webinar, which we welcome you to, me from a very cold and clammy Geneva. It's a webinar entitled Macroeconomics and Debt Policies Facing the Challenge of Tapering. Now, for those of you who are not aware, the work that we're presenting today is part of the output of an UNCTAD-project that's entitled South-South Integration and the Sustainable Development Goals, Enhancing Structural Transformation in Key Partner Countries of the Belt and Road Initiative. Today's webinar is being organized by UNCTAD and our partner in Ethiopia, Policy Studies Institute, the PSI. This is the third of a series of such webinars which have engaged in discussion on macrofinance, debt strategies, global value chains, trade and industrial policies, and digital policies for each of the 3 beneficiary partner countries that we've engaged with in this project, including Indonesia, Sri Lanka, and today, Ethiopia. Today's event launches the case studies on macrofinancial and debt sustainability policies that were prepared for Ethiopia under the UNCTAD-project and discusses their findings. Sorry, may I just ask if you have just joined, if you could please mute yourself. Okay, let me just continue. So today's event launches the case studies on macrofinancial and debt sustainability policies that were prepared for Ethiopia under the UNCTAD-project and discusses their findings in the context of the challenge of possible tapering for macroeconomic and debt policies in developing countries. We have 90 minutes together this afternoon, and I'm immediately going to begin by asking Ms. Stephanie Blankenberg, who is the head of the Debt and Development Finance branch in the Division on Globalization and Development Strategies of UNCTAD, to introduce this session to us with some introductory remarks. Over to you, Stephanie, and welcome.
Thank you, Penelope, for the introduction, and allow me from UNCTAD's end to welcome the participants of this workshop very warmly. This is forms an important part of our work, and I'm delighted to see this workshop being attended so importantly. Now, I will just say a few words, introductory words on what we consider to be the global setting to address macrofinancial and in particular also debt challenges in developing countries more generally, that of course also are relevant for Ethiopia. Now, to set that picture, let me just point out that in our last trade and development report, we made it clear that on our expectations, we're looking at a situation where world output fell by 3.5% in 2020, but are expecting it to grow again by about 5.3% in 2021, with the final figures yet to come through. But what that means, while this looks positive at first sight from 2021, what this though means is that assuming an average global growth rate of global output, annual global output of around 3% between 2017, 2019, so working on that basis, we would still be looking at a very considerable loss of global income, of this remaining just short of 4% below its pre-pandemic trend in the current year, so in 2020. And more to the point, it would mean that the cumulative income losses in 2021 and 2020 and 2021 would mean that global output, assuming the average output growth rate, global output growth rate in the years just preceding the crisis, that we would not revert to pre-COVID-19 trends before 2030. Right, this is particularly important for developing countries to get a longer-term perspective of the kind of uphill struggle that we are looking at, and that of course poses unprecedented challenges to developing countries who have by far suffered the worst economic and social damage in the wake of the COVID-19 crisis. While falls of output were initially more dramatic in advanced countries, it is developing countries that have suffered the worst longer-term damage from this crisis, with levels of informality being very high and health and social protection systems. Hello? Can you hear me?
We can. I'm sorry. Just for a minute, you seem to have.
Oh, okay. I got a message. I was muted, but when I actually wasn't. So you can hear me now.
Yes, please go ahead.
Now, this is the sort of very broad growth picture that's not exactly rosy. And as I said just now, it's especially not for developing countries. And that's the case, of course, against the background where fiscal spaces had been heavily squeezed in developing countries even before the crisis set on, and that was a legacy of sluggish global recovery from the global financial crisis. So over the decade prior to COVID-19 hitting us, and as well as, of course, decades of capital account liberalization and financial deregulation that turned in particular developing country debt from what is supposed to be a tool of developmental policy into a speculative financial asset very largely. Reflected, not least, of course, in the integration of developing countries into international financial markets and shifts to much stronger reliance on private rather than multilateral and bilateral creditors. Now, from the perspective of the developing world as a whole, that has meant that by end 2020, for which the latest data is available for all of these countries, we hit a record high of above 11 trillion US dollars in external debt, of total external debt. That is short and long-term debt in developing countries. That's about double the amount in 2009. And this burden grew by about $500 billion in 2020 alone. So 500 billion in 2020 alone. And of course, the implication is not only in these absolute values, but also in the rise in debt servicing costs that now amount on average for developing countries. And that values can, of course, be much higher depending on which country we're looking at. About 16% of export revenues in developing countries going exclusively to servicing total external debt. Now, to give you an idea quite how unsustainable this is, and I can only emphasize in particular in some small development island states, but also other smaller developing countries, these figures are even higher, to give you just an idea of how unsustainable it is to have to dedicate on average 16% of your export revenues just to servicing external debt. It's worthwhile remembering that in a agreement between Western Germany at the time, Western Germany and Allied forces in the early 1950s, it was agreed that in order to not undermine West Germany's post-war economic recovery, it should cut off any kind of debt repayments, should have these automatically suspended if these exceeded more than 5% of its export revenues, with a clear view to ensuring that any kind of debt restructuring agreement would not undermine the economic recovery of post-war West Germany. It's a sort of historical measure of what was considered sustainable, if you like. We are now more than 3 times above this for developing countries. And in addition, of course, we are also looking at a situation where over the remainder of this decade until 2030, many developing countries, including some low-income developing countries, there's what has often been referred to as a wall of debt in repayments on sovereign debt, bond debt, that, according to our calculations with data available towards end 2020 on this, amounted to about 1 trillion of repayments due in sovereign bond debt until 2030, spread differently across years, across years, of course. Now, that gives a broad impression on quite how serious the situation is generally in developing countries. And this contrasts, of course, with a situation where during the COVID-19 pandemic, the multilateral response to address, in particular, external debt pressures on fiscal spaces in developing countries has been very poor. I'm referring here to the G20 response in terms of their debt service suspension initiative, or so-called DSSI, and now the common framework on the one hand. On the other hand, of course, a response that was widely welcome, namely the new allocation of special drawing rights. Now, I don't want to take up time here to go into detail on this, but clearly, overall, for developing countries, the DSSI has been a two-sided sword. It's affected around just over 10 billion. Remember, I said it was 500 billion increase in total external debt in developing countries overall in 2020 only. And the DSSI has suspended 10.3 billion until between May 2020 and June 2021 in service payments on parts of this debt, and emphasis here is on suspensions. Of course, the repayments have already set in, depending on when countries started to join the DSSI with different periods of repayment until 2025 or 2027, depending on the exact dates. And the common framework has come into force, but has been taken up sparingly for a number of reasons that maybe in the course of this discussion will also come up. I'm of course aware that Ethiopia is a country, is both a DSSI country, as well as one of only 3 countries that have applied to join the common framework. So there may be ground for debate, especially given that Ethiopia's global economic outlook, of course, looked not bad, to say the least, until about 2017, but has seen rising dependence on external financing, and has had access in this context on 2 concessional loans. So it will be interesting to see in the upcoming debate what exactly the take is on the sustainability, even given access to concessional financing, on Ethiopia's rising experience on external financing, and in particular on multi and bilateral external debt in this context. Now, a final word, since this has been highlighted in this context, of course, is the context of uncertainty in which developing countries operate, as far as the wider global picture is concerned. Below what I've already briefly mentioned in terms of rough prospects that are worrying, there is, of course, the challenge of tapering or the reversal of quantitative easing that is being widely discussed. The point here, to my mind, in particular, is that while in 2013, the so-called tantrum, which is a slightly flippant word probably for what happened, turned out to be less severe in the longer run than was at the time expected. The point here, though, is that we're entering a space or a context in which there are systematic factors driving uneven growth between developing and advanced countries, and that have been highlighted, but also worsened during the COVID-19 pandemic. So while there's some reason to at least believe that the strong inflationary expectations for advanced economies that are driving move towards tapering in these countries may slow down this year and the next year, the very point of understanding how these things work is, of course, that this doesn't mean that expectations of further inflation have not already been brought into the system, and will therefore run their course. And of course, the impact may very well be handled, in my view, certainly, in our view, certainly in advanced countries. But once this kind of spiral comes underway, and this time it's not like in 2013 that it is, if you like, a temporary speculative bubble of sorts. This time it does hit an economy, a global economy that already structurally is on a two-tier track. The effects on developing countries are very likely, in our view, to be severe in terms of increasing the pressures I've already pointed out on external financing and external debt burdens, in particular, with the well-known concurrent spirals entailing currency depreciations and economic hardship, plus financial instability. In these countries. So the main point here is that strongly defined by policy decisions made for advanced countries in advanced countries. This time around, notwithstanding speculation of the severity of this in advanced countries, it will hit developing countries very badly against the background I have outlined. So these are sort of few introductory words to sort of set the scene, if you like, from our end, from my end, and I very much look forward to discussions and perspectives from country levels on this in the subsequent debate. Thank you very much.
Thank you very much, Stephanie, and thank you for that exceptionally helpful introduction. I'm going to turn over immediately to Professor Petros. Thank you so much for joining us, and over to you, sir. I'm very sorry, I cannot hear you. Professor, I cannot hear you. I'm sorry, if you could perhaps unmute yourself.
Hello?
Yes,
Can
we
you hear me now?
you.
Okay, you hear me now? Okay, distinguished participants, ladies and gentlemen, in my capacity as Director General of Policy Studies Institute, Ethiopia, it gives me great pleasure to deliver a keynote speech at the opening of the webinar series, South-South Integration, Sharing of Policy Experience, organized by the Policy Studies Institute and United Nations Conference on Trade and Development, UNCTAD. Today's webinar is on the challenges of macroeconomic and debt policies. I would first start with a cursory note on the state of Ethiopian economy and the challenges. Ethiopia is the second most populous country in Africa, with a population of about 115 million as of 2020. Since 2004, Ethiopia recorded rapid growth in GDP. Correspondingly, the GDP per capita had risen to US 2,422 in 2020. The agriculture, service, and construction sector have contributed a significant part to the growth of the economy. The government had allocated resources for poor growth, which has led to a significant reduction in poverty. Despite the high growth period, GDP per capita, PPP, is below the sub-Saharan African average of US 3,904 in 2020, showing the importance of keeping fast growth. Moreover, the economic growth was accompanied by domestic and external imbalances, resulting in high inflation. That's 20.16 in 2020, persistent trade deficit, debt distress, and overvaluation of exchange rate. Ethiopia has poor tax revenue mobilization performance, i.e. 9% of the GDP in tax revenue compared to 16% for sub-Saharan Africa peer countries. Government expenditure efficiency is also a challenge, leading to inefficiency managed public investment projects. Ethiopia also runs a trade deficit due to an ever-increasing import in the face of stagnant export performance. Although domestic saving has increased during the high growth period, the increment in investment expenditure has been faster. Hence, the saving investment gap has widened, exposing the country to rely on external financing. A crucial explanation for the widening saving investment gap is the underdevelopment of the financial sector by global and regional standards. In Ethiopia, less than 35% of the population is banked, and the number of individuals using digital finance is very low. The number is small compared to peer countries in the region. The insurance market penetration in Ethiopia is also low, only 0.04% compared to 2.4% in Kenya and 1.7% in Rwanda. Ethiopia, like other countries, is also facing the social and economic impact of COVID-19 pandemic. Moreover, the conflict in northern Ethiopia is an obstacle to getting the economy back to progress. Ladies and gentlemen, please allow me to make a statement towards a stable macroeconomy in Ethiopia. Ethiopia's economic challenges are not inherent. With the right policies and commitment from all stakeholders, the country can solve its problems and continue to make progress on all fronts. To this end, Ethiopia has developed a homegrown economic reform plan in 2019 to ensure price stability, financial access, and debt sustainability. It has also developed a 10-year perspective development plan that builds on the conducive environment that HER creates. The 10-year development plan will cover the period up to 2030 and aims to shift the development towards a private sector-driven economy. Research institutions like the Policy Studies Institute play a key role in conducting rigorous investigations and analysis in specific areas. Policy Studies Institute's main mandates include undertaking policy relevant research and developing recommendations for evidence-based policies and strategies. In PSI, there are specialized research centers. Among these centers, Macroeconomic Policy Study Center is responsible for conducting research on macroeconomic issues like economic growth, fiscal policy, monetary policy, current account deficit, exchange rate management, tax revenue, public expenditure, and welfare issues. In this regard, the current fiscal year, the Macroeconomic Policy Study Center has been investigating policy gaps on two topics. One, Ethiopia's macroeconomic and finance policy framework for structural transformation. Two, debt sustainability and management in Ethiopia, lessons from China. The two studies are now complete and ready for dissemination to different stakeholders. Today's seminar is one of such dissemination tools. The studies address the following. One, how to sustainably finance investment. Two, how to induce structural transformation in a stable macroeconomic state. And three, what lessons we can draw from other countries such as China. I hope that every participant will engage actively in the event to develop new insights regarding our country's macroeconomic challenges and prospects. Thank you very much for your kind attention, and I hope the seminar will be a great success. Thank you again.
Thank you very much, Professor, for that very helpful keynote address. We're now going to move straight into the first presentation by Firio Wildes, who is a lead researcher at PSI Ethiopia. And he's going to begin by talking about debt and debt sustainability. Thank you, Firio, over to you.
Thank you, Penelope. I would share my screen first. Can you see my screen?
Yes, that's looking excellent. Thank you, Firio.
Thank you. Okay, as was stated earlier today, we're going to cover two areas. One is a macro policy and the other is a debt policy. I'll be talking about the debt sustainability and management in Ethiopia and lessons that we can draw from China. And I will pass the mic to my colleague Andrew for the macro financial sector policy discussions. My presentation will have 4 parts. I would start with the introduction and providing context, comparing China and Ethiopia. The second section would focus on factors contributing to the rising external debt in Ethiopia. Third section will deal with the situation of debt sustainability and debt management. And finally, I will conclude by highlighting the lessons that we can draw from China. China has been growing for about 4 decades now, continuously, and Ethiopia have started growing relatively rapidly around 2004. And as you can see in the graph, the lower panel, where the red line is GDP per capita in PPP for Ethiopia for the period 1992 to 2020, and you see the king there. And the upper panel is GDP per capita for China. And in 1990, China started where Ethiopia was in 2010, and by 1997, China has attained the level Ethiopia is today now, around 2,300 USD per capita income. China has progressed after that rapidly, and so there are a lot of things that we can learn from that. And one of the characteristics of the growth, according to Liu, is capital accumulation, a significant capital accumulation that drove China's growth. So we've sort of compared the investment to GDP ratio for the 2 countries to see how things have been going on. On the left panel, you'd see Ethiopia, and on the right panel, you'd have China, and the x-axis is the year, and on the top, you have the investment as a share of GDP. Ethiopia's investment as a share of GDP has steadily increased from about 15% to 37% if we take a period of the different periods into account. And most recently, it's 37%. That is comparable to the 1980s and 90s in China. GDP investment as a share of GDP was 37%, and it further continued to increase afterwards. And so it highlights that if Ethiopia is to continue to make gains in terms of improving its economy, it has to maintain a very high level of investment as a share of GDP. So that's a very similar sort of picture for both China and Ethiopia. However, where they differ is in terms of national savings, gross national savings. If we compared for the national savings of Ethiopia to China, would see that in Ethiopian case, national saving was not sufficient to cover the investment required. Therefore, there was a reliance on external financing. Whereas in the case of China, the national saving is either at the same level or even higher than the investment. So that's a major difference between the 2 countries. In terms of the debt, Ethiopia's external debt to GDP ratio has been increasing along with its growth path. Of course, this is to be expected considering the gap between saving and investment. it's now around 30% of GDP, the external debt. Similarly, the total debt to GDP ratio has increased, and it's around 56% of the GDP. If we look what happened in relation to external debt stock in China, it has initially increased when it started its growth in the 1990s, but then it has never been above 19%, and recently it has even gone down. So the level of external financing is also quite different between China and Ethiopia. So what's driving the rising external debt in Ethiopia? The first thing we've looked at is from the public investment side, what are the factors that could actually contribute to this? And one of the things we've observed is that public investment management, although it has a strict process, there is always room for exception, and there is no limit to how much that limit can be used. That's to say, there are projects that just passes the usual process, and there is no limit how much of those can go on. Second, around 2010, the government development plans, we have a 5-year development plans, included project without secured financing. So during, for example, for the construction process, during the bidding, prospective contractors will be asked to find source of financing, which is not in the budget. And this, of course, has eased the resource constraint, but it has also contributed to the rising external debt, and perhaps might have even contributed to reduced effort in revenue mobilization. Low tax collection performance has been contributing to that as well. And the other point is the involvement of commercial and financing of public projects, which were not market driven. So it's really that public investment projects have no checks in terms of the financing from the domestic side. So then I will go to the debt sustainability and management issue. I have here a few indicators on the table, and I would compare that with debt sustainability indicators used by the World Bank and IMF joint debt sustainability analysis. When we look at the debt sustainability indicators for Ethiopia, debt to GDP ratio was at least in 2009 around 19.54%, compared to the threshold of 40%. It's way below the threshold in present value terms. Whereas debt to external debt to export ratio has breached the threshold. It's around 245% for Ethiopia, and the established threshold is 180. External debt service to export ratio also breached the ratio. So that's also another area of weakness. It's around 26% for Ethiopia debt service to export, whereas the threshold is 15%. Finally, debt service to export ratio, although within below the threshold, it's very much closer to the threshold and would breach under different stress test scenarios. So the major vulnerability for Ethiopia comes in terms of debt from the external side, that there is extreme reliance on external financing compared to the ability of the economy to generate external resources. So in response to that, the government debt management strategy tried to limit on non-concessional borrowings. And that has been adopted since, I think, 2016 or something. The other issue is Ethiopia has been trying to benefit from the debt restructuring or debt treatment under the G20 framework, common framework, and is waiting to benefit from that. Ethiopia has already benefited from the debt service suspension initiative, which is an initiative that's correlated with COVID, which allow countries to suspend their debt service payments for a short period of time. Considering the external debt distress Ethiopia is facing, the debt service suspension is not going to make a major impact in terms of the debt sustainability. So it would require a more rigorous work in the debt treatment to sort of bring the debt levels of Ethiopia to a manageable, to a sustainable level. That's to say some of the debts has to be rearranged in a way. Finally, what lessons can we draw from China? The first point I would like to raise in that regard is the role of local governments in selecting investment projects, which was prevalent in China, but this was not the case in Ethiopia. Perhaps with the exception of Addis Ababa, the local governments are not really working on public investment as such. They're just paying salaries for public servants. So that's one difference in terms of, this might also help for the efficiency of public investments. The second point is Ethiopia's reliance on external financing in what it lacks in terms of domestic saving. That's not the case in China. Third, access to finance for public projects was market-driven, whereas in our case, because the government also have access to public commercial banks, most of the time the financing from the banking side is not market-driven, rather we can say it's a policy-driven. Finally, state-owned enterprises are critical for development, but they have been underperforming. In most of the projects are not completed on time and on budget, and that has contributed to the problems in Ethiopia. So these are the major points. I thank you for your attention, and then I'll pass to Penelope. Over to you.
Thank you so much, Huru. Can I invite your colleague, Angoulême Mengistu, to take over and to share his screen and begin his presentation? It was very insightful, and I think we're now ready to hear the macro financial section.
Thank you, Penelope. How many minutes do I have? Just to be done.
Thank you. We can see the presentation. That looks excellent.
Yes. How many minutes do I have, by the way?
If you could speak for between 8 and 10 minutes, that would be perfect.
10 minutes. All right. Okay, I'll try to keep it short. So today's presentation is on the macro financial policy and how much Ethiopia can learn from China's experience. In terms of structure, I will first discuss or briefly highlight the experience of China and Ethiopia in their comparative development phases. And in part two, I'll try to tease out some policy lessons. And finally, I will highlight how potential tapering, upcoming potential tapering may affect the country and its policy future. So in terms of comparison, basically, appropriate policies depend on the level of development of the country or the development phase of the country. So when we compare, I choose comparable developmental phases of China and Ethiopia. For that purpose, I picked the period 2000-2018 in Ethiopia and 1981-1990 in China. So whenever I show you some graphs, year one refers to 1980 China and 2000 in Ethiopia. So the first thing we see is that the two countries have more or less developed similar GDP growth paths, which is positive news for Ethiopia in a way, right? So given the current trajectory of China, so these are the numbers. But however, in terms of structural change, the two countries had divergent paths. So there is a change, there is a decline from agriculture to services in China. And in Ethiopia, it's more to industry, like a decline from agriculture to industry. Unfortunately, most of the decline most of the increase in industry in Ethiopia is due to construction sector that's financed largely by government investment, and which in turn is largely financed by foreign borrowing. So for that, we can see, like, especially the manufacturing sector actually declined in Ethiopia to 6% from 9% in the initial period. But in China, by the comparative development phase, they have about 30% of their economy was manufacturing. So in a way, although growth was significant and parallels or mirrors the experience of China, the underperformance of manufacturing sector and its importance shows that in terms of structural change, the economy didn't perform very well. Another significant pattern is that in terms of price stability, the Chinese economy experienced relatively smoother price movement than was the case in Ethiopia, as you can see. So basically, we have about 3 up to 5 percentage point difference on average inflation. Another factor is in terms of real exchange rates. So if you look at this path, this is Ethiopia and this is China. Over time, in the comparative development phases, the Chinese real exchange rate was depreciating actually, and Ethiopia's was appreciating, right? So in particular, so if we look at Ethiopia's experience, like after the fall of the Derg, probably in the early 90s, it was depreciating. But as you can see here, like it's starting from around 2003, which was the period where significant government investment started happening in the country, real exchange rate appreciation follows. So this is a mirror image of the performance of the economy, right? So significant investment coupled with growth in construction rather than manufacturing is a mirror image of the overvalued exchange rate, because non-traded goods were being produced in the country. As a result of the underperformance of manufacturing sector, and partly due to overvaluation and associated factors, in terms of export, as you can see, in Ethiopia, the manufacturing goods as a share of merchandise export actually declined over the years. In China, while in China, it actually keeps increasing over time. So in both total production of the manufacturing and in export, the two countries had divergent experience. So the initial GDP growth that we saw hides a lot of difference between the two countries. Now, one factor one can think of about underperformance manufacturing sector is maybe in the Ethiopian case, there is less local capability or maybe less local finance to own manufacturing. And one source that can be mobilized to increase the performance of the manufacturing sector would be FDI. And as you can see, in initial period, due to a lot of incentives, FDI was performing relatively better in Ethiopia, but it has sharply declined in recent years. And notice that this decline is actually in the face of declining GDP growth as well. So this is not a very good indicator for the country. So these are like, just to keep the presentation short, basically volatile inflation. In Ethiopia, we see the volatile price bars or inflation and competitive real exchange rate, lagging FDI in manufacturing, and as I will show later, reliance on debt financing characterize the country's development so far, compared to China at least. So can we learn something from China's macro policy? One thing we can learn is, I'm gonna just skip this, and I would say monetary policy should be proactive, right? So in our case, in the Ethiopian case, monetary policy is subservient to fiscal policy. So the national bank is expected to finance government deficit, and as a result, it accommodates all demand and supply shocks. And also the national bank doesn't have sufficient monetary policy tools. There are several developments in the last couple of years to be able to equip the national bank with lots of monetary policy tools, but they have not completed the process yet. And I'm hopeful that will be helpful. But so far, that's not the case. So that's why we see monetary policy not proactive. We see that it leads to higher inflation in the country. And the other side is, if you can see here, or this picture is better actually, is if you can see here, real interest rate on saving and is about negative 10% on average in our country, which is a significant amount of financial repression, basically, right? So that coupled with lack of capital market in the country doesn't incentivize domestic saving, right? So that is, this picture will show us, okay, if you can see here, China's domestic investment. This is China's domestic, yes, gross. Okay, let's see, gross capital formation in China and Ethiopia's gross capital formation are similar, actually, if you look at them over the years. But in terms of domestic saving, China's domestic saving is much, much higher than Ethiopia's domestic saving. It's partly reflective of the fact that they were successful in export, but partly reflective of domestic saving behavior, right? So this gap, the gap in Ethiopia in terms of investment and saving, will be filled with external saving, right? External saving in terms of borrowing, aid, and remittances. So I think monetary policy and in general the capital market policy of the country should be able to incentivize domestic saving in order to avoid significant external borrowing that leads to a debt stress, right? And finally, I would like to say in terms of policy lesson, if you look at if you look at this picture, I showed earlier, real exchange rate have been appreciating, and similarly, if you look at this is a parallel market premium. It reached about 30-something% in recent years, which shows the same thing in terms of the fact that our exchange rate management has been unsuccessful in keeping the country's exchange rate or currency competitive in international market, which unlike the Chinese case, right? And as a result, over time in China, like they were able to relax their foreign exchange market and incentivize exporters more. In the Ethiopian case, over time, actually, most of the rules have been discouraging exporters, right? So they have to surrender most of their forex. That has a negative implication for our exporters. So a significant improvement in our forex management probably would be a lesson that we should be learning. And Finally, I would like to say a few words on tapering and its implications. By tapering, we mean if the Federal Reserve in the US and other national banks stop their loose monetary policy and asset purchase, what we will see is an appreciation of the dollar and an increase in yield, right? So that may have implication for even for official lenders as well. Their interest they will charge will increase. And as Freo earlier said, that one of the modalities the country uses in terms of its public investment is the contractors mobilize their own finance and build the infrastructure, and that these contractors may not be able to mobilize the necessary finance because finance may be chasing as a higher yield, and also even if they manage to mobilize, they may be able to under an increased interest rate, and that will cost the country dearly, right? So those are, and finally, in terms of one other implication of tapering is on commodity prices. A slowdown of global growth may affect commodity price, but the implication is ambiguous because decline in fuel prices will be positive news for the country, but at the same time, the decrease in coffee and other commodity prices may affect the country negatively. That's all I have for now. Thank you.
Thank you very much, Antolam. Certainly from our perspective, it was very interesting to see that, particularly, of course, the discussion on the so-called savings gap, whether in fact this is a passive result or in fact the origin of your problems, of course, could be debated. But thank you very much for a very useful and clear and distinctive presentation of the development between Ethiopia and China, albeit for different periods, but both of those presentations were really helpful. I'm going to turn over now to Abdul, who's going to present, hopefully quite briefly, because we've already seen Indonesia's case in a previous series of webinars, but just to ask Abdul to highlight the issues that he thinks are most important for us from the Indonesian case. And if I could ask you to just restrict your comments to around about 8 minutes. Thank you very much.
Thank you, Penelope. Thank you all. I would like to present my paper with Mr. Eko. We are talking about the debt sustainability and debt management in Indonesia, reflection of applicability of Chinese policy. You can see in the first slide that China experienced with high economic growth in the last 2 decades. We can see that if when there is a crisis, China is not impacted significantly. But in Indonesia, when the financial crisis and monetary crisis happened in 1998, 1997, it is a significant impact on the economic growth. The impact of economic growth declining is can be seen from the GDP per capita. We can see in the right graph, Indonesia and China actually were low income countries with low GDP per capita. However, China successfully reformed its economy using foreign direct investment, whereas Indonesia is trapped by foreign debt. From the summary external debt, we can see that Indonesia has high external debt dependency. It can be seen from the general government external debt stock. Indonesia reached 49%, while it was only 9.3% in China. How about the debt ratio? In this slide, we prepare several indicators, for example, external debt stock to export, external debt stock to GNI, debt service to export ratio, and short-term to external debt stock. From this graph, from this table, we can conclude that China has much more soundness in the term of debt ratio. while Indonesia has more fragile because, for example, we can see from the external debt stock to the export, in Indonesia it is more than 200%, while in China only 79%. What several differences between China and Indonesia policy from the perspective of debt? The first is we divided for the 4 indicators. The first is development or reform approach. Actually, prior to the crisis 1997, Indonesia used a macro first approach, which focused on agriculture and prepared to move to industrial sector. But after the crisis 1997, Indonesia adopted a macro first approach with globalizations and privatizations. The problem is Indonesia has poor government bureaucracy with high corruption in the new order era. However, in China used micro first with gradual reform. China combines structural transformation, economic liberalizations, and institutional transitions. But China is very unique approach. China will reform its sector if the sector is ready to reform, to liberalize. China also has powerful government, and so the government target seems to be achieved by the second indicator financing. In Indonesia, after the oil boom 1976, Indonesia financed its economy with foreign debts, with several consultative groups for Indonesia, the CGI, and we cannot maximize the role of foreign direct investment because the poor investment climate. And in the term of financing, commercial bank was formed in the 1983, but only impacted to the size, not the financing. On the other hand, China has transformed its economy by using the foreign direct investment that can accelerate and contribute to workforce absorption, technology transfer, and the human capital improvement. China also benefited from the role of TVE, town and village enterprises, in the regional economy, and its increase after the reform. China also have banking sector and contribute significantly in the role of economic reform. China has specific bank that are responsible to specific or to vital sectoral. It is very different in Indonesia. Indonesia has more than 100 banks, but the role is very limited. How about the fiscal sector? In Indonesia, our tax ratio remain lower than 10% due to low tax base. Our tax revenue is very fragile because it is very dependent on the commodity price, and Indonesia also has high informality sector, so the government cannot raise the tax from the informal sector. On the other hand, China has tax ratio more than 15%. This level is sufficient for country to fulfill the basic needs of citizens and businesses and put a country on the growth path. In the term of distress, Indonesia applied the Maastricht Treaty. It means Indonesia has the rule that government and the House representative should meet. For example, we must meet the maximum fiscal deficit 3% of GDP and government debt maximum 60% of GDP. However, in China there is no limitation for fiscal deficit and the government debt. What Indonesia can learn from the China? The first is the power of transformation is due to its unique approach, strong government and policy consistency, and the role of banking sector, high income tax driven by domestic resources, and sound and monetary sector stability amid lower foreign debt. I only will explain about the sound and monetary sector stability because the rest has been stated above. China has a solid monetary policy, maintaining debt risk and especially foreign debt. On the other hand, China foreign debt is relatively low, only 14%. So exposure to the exchange rate is very low. And next, I will present about the Indonesia economic challenges for the 2020 and for the future. Maybe the first is from the fiscal policy. The challenge is for the next, maybe there is a tendency to increase the debt because the problem very fundamental from the state income tax revenue has dependency of commodity price, as I said before, and you know that the demand of raw material is predicted to decline as the global concern on clean energy policy. On the other hand, state expenditure, the number of the share of the mandatory spending is very high in our state budget. And we need more spending to stimulate economic growth and cost to vaccine and additional spending that government has ratification about the budget to new capital. So our new capital will be moved to North Kalimantan, and it needs more money to realize this target. Another important issue is the fiscal deficit should be at 3% of GDP in 2023 after it was relaxed in 2020 until 2022 as the COVID-19 spread in Indonesia. How about the monetary sector? The most problem in the monetary sector is how the impact tapering and the Fed fund rate increasing. It will push Central Bank of Indonesia will increase the interest rate benchmark. It will happen in the second semester of 2022. It is aims to manage exchange rate volatility and maintain the interest rate differential in order to maintain the investor perception. The consequence of the increasing the interest rate benchmark, maybe it will be impact to declining economic growth. Another problem is how the impact volatile food inflation, low loan growth remains low, and crowding out effect since the Central Bank of Indonesia become the standby buyer of the government bond. On the other hand, commercial bank collect more government bond to maintain their interest income. So the loan to the real sector is very limited. That's because the problem of crowding out. How the impact of the tapering of 2022 in Indonesia. In this slide, we can see the comparison situation of Indonesia in 2000 and 2021. Mostly, we see the macroeconomic data is more sound compared to 2013. I noticed from the fiscal deficit, energy subsidy. We must notice that in 2013, the problem is not only the tapering off, but also increasing of commodity price. That's why the impact to Indonesia is very material, because Indonesia still has energy subsidy is very high, almost 4% of GDP, while in 2021 is only 0.66% of GDP. How about the risk? We have several risks that very important for Indonesia. The first is share of foreigner in the government bond. In 2013 it's almost 33%. How about in 2021, it's only 19%. The same situation happened in the foreign sale in the stock market. It's in 2013 almost 61. However, in 2021 only 41. It is the same situation in another indicator like credit default swap, government bond yields, and the most important is current account deficit. In 2013, our current account deficit is 3% or 3.19%. However, in 2021, it's only 1.5%. It means we are very not worried about the impact of tapering of 2021 from this data. How about the impact in tapering of 2013 in the term of exchange rate of rupiah against to US dollar and debt to GDP ratio? It is the graph is very clear. In 2013, we can see the rupiah depreciate 26% against to US dollar. However, the Fed announced the tapering in the 2013, but the action happened in the 2014. But the situation very worse for Indonesia because the Fed also didn't give a clue very clear. It is compared to the 2021. The Fed give the signal very clear to the another country. The debt to GDP ratio also experienced the same. We can see the situation of in 2013, our debt to GDP increased from the 29 to 32, and continues to increase because several disruptions in economy. For example, oil price in 2015 and trade war in 2019 and COVID-19 in 2022 and 2021. Thank you, Penelope. That's all from me. Thank you very much.
Thank you so much. That felt like a whirlwind, but so much very useful information. And thank you especially for your slides on economic challenges and on the effects of tapering, which have gone beyond the project definition. Thank you very much. May I ask Kenneth if you could close off the speaker session now. Perhaps if you could also try and keep your intervention short, no more than 8 minutes. Thank you very much.
Thank you, Penelope. Good evening, everyone. It's a pleasure to be with you, each of you. We listened to some very interesting presentations from our members. Some of those presentations actually resonate very well with the Sri Lankan experience. And I was just amazed to see the similarities of some of these economies as they transfer their economic structure from internal debt-driven kind of economic structure to an external debt-driven structure, and the implications of doing that in terms of keeping the balance between your real exchange rates, your inflation, through your throughput, and also looking at your export competitiveness. Now, from a Sri Lanka point of view, I've just got to highlight a few things. I was asked to highlight Sri Lanka's economic journey and when it started in relation with Chinese, in the context of the Chinese relationship that we have. So I like to break the Sri Lankan economy down into three main areas or three main phases. The first phase we saw between 1950 to about 1977. That period was a closed economic period where we had a nationalist government, but the GDP grew at about 5.5% on average. And then we came to a where rapid liberalization to away all the checks and balances away from the real economy, which saw also a marginal increase in the overall GDP growth, but with it came the increase in external debt financing. So if you look at our external debt financing, right, the journey between the overall negative balances in the trade, plus our negative current account balances, plus the widening fiscal balances, have a fairly interrelated story. And the story being this. So 1977, we liberalized, we took out all checks and balances, we did away with the development banking concept, which China actually does so very well. I mean, it has resonated across all our presentations. The development banking concept was thrown. We see that that pivotal pillar in the economy is essential for economic growth, which many of these countries didn't have, and so did Sri Lanka, missed out on that opportunity. And as a result of that, growth tapered off. So policy injections and policy measures could not be executed because the banking sector was utterly resistant to financing development projects because of the gestation period and also the conflict between shareholders and the balance sheet risk that comes with long-term risk financing. So that itself compromised the GDP, and therefore GDP contracted. It contracted right down till 2009. From about 1983 to 2009, Sri Lanka went through a horrific period in its economic history. We were exposed to a civil war. For 30 years, we battled that war, and economy couldn't reach its full potential. It reached about a 4.5% growth, but with it also came some external debt constraints and debt borrowing. So 2009, we started a new economic journey after the war, when the war ended. And from that period to about 2014, we saw rapid economic growth, with the state playing significant role and bringing back the development banking drive to ensure that the economy started to shift beyond its potential, and we reached about a 7.5% GDP growth, very much similar to what China did. Given the fact that we are a democratic country, the democratic cycle itself ensured that we reversed those particular policies, and we went back into a liberal state of affairs, which saw the economic contract from 2015 to 2019. The contraction was quite sharp. Top line revenue numbers, which is your GDP numbers, contracted from about 5% to about 2.3% to 2009, which also meant that when your revenue was contracting, your GDP, debt to GDP stock remained constant, and the debt to GDP cost, the cost continued to increase because of a high dependency on external financing. Some of the similar features we see in Indonesia, Ethiopia, and rest of the presenters who did present. So our external debt vulnerability increased. We were pushed to go into external funding. We were pushed to go into external capital markets. We raised about $16 billion from 2009 to 2020. That put enormous pressure on the country because our country's revenues were declining, particularly external revenues, and our external competitiveness was impeded because of the fact that we didn't focus on industrializing our economy, whereas the East Asian economies did that very effectively. China shows how industrialization really works and what it means. It has sustained its industrial policy for 40 years. And with that policy framework, you are seeing sustained high growth rates in the economy, unparalleled to any Western or any Asian, East Asian or South Asian economy. So those are some of the nuances that you see coming out from our analysis. I think a majority of us have shared the same concern. But I think the more important point is how we can restore global competitiveness from an individual country's balance sheet point of view. The country's balance sheet is a pivotal part in looking at your fiscal support. And with that fiscal support comes fiscal stability and monetary policy stability. If you don't have that, then you are going to be exposed to further borrowing, further deficits, and further fiscal difficulties and austerity at some point, because your balance sheet has to contract. There is no way that your economy can grow with the piling up of external debt, and there is no capacity and there is no fiscal stimulus that's going to work. There is no monetary stimulus that can work when your balance sheet is highly leveraged, and that is with regard to your national balance sheet. Your national balance sheet is a function of your domestic companies. So if your domestic companies are leveraged, then that microeconomic variable has an accumulation at a national level. Your national debt tends to reflect that microeconomic fundamentals of high leverage. And that is what we are seeing today globally. Globally, balance sheets are stuck. Global debt to GDP is around 350%. And there is no room to take on more expansion. So the global economy is exhausted with national debt being balance sheet debt of firms, and firms leverage at all multiple sectors show the same numbers. I looked at the numbers of 24,000 balance sheets, and those balance sheets reflect this debt issue. So the debt issue is a stifling point for the global economy. It's a stifling point for Sri Lanka. It's a stifling point for the rest of our member countries, including Indonesia. And that vulnerability has increased because we have been pushed to go and borrow externally. And with that external borrowing, Indonesia spoke about the credit default swap ratios widening. Sri Lanka is similar. And when you have an external credit rating vulnerability and your external debt stock rising, then you are hard pressed. There is no room to go into international capital markets and borrow. So Sri Lanka had a similar situation, and therefore we have restructured the balance sheet. We are going lesser to capital markets, more to domestic financing. We are looking at that very strongly. I think Indonesia resonated the same type of story. Ethiopia the same. So Sri Lanka is also no different. So Sri Lanka has to move away from excessive external debt financing, not multilateral and bilateral debt. I think that's where China came in in 2009. They supported Sri Lanka's growth story right from that period onwards. Having said that, Sri Lanka, China has had strong cultural relationships dating back to the 5th century AD. Sri Lanka has had many other trade pacts with China since 1952. One of the key trade pacts that we did sign with China in 1950 was the Rice Rubber Pact, which led to strengthening Sri Lanka's ties with China. And also we had the scholar and religious monk that visited Sri Lanka during the 5th century AD, Fahian, who visited Sri Lanka and exchanged cultural ties between China and Sri Lanka. That bond still exists very strongly between China and Sri Lanka on a cultural side, and also the trade side is more solidified as a result of this 1952 Rubber Rights Pact, and also Sri Lanka's Economic and Technology Cooperation Agreement with China in 1962. And since then, China has gradually picked up its trade relationships. China is a big trade partner with Sri Lanka, like it is with every other country. We've seen that in Indonesia, we've seen that in Ethiopia, rest of the world. I mean, the numbers don't lie. China is a country with a huge trade surplus and a huge foreign exchange reserve. The reserve is a function of China's ability to earn and compete on the export stage and take away market share from many other companies and countries. So that's the model that China has used very successfully. I think countries can learn. The old economic models are becoming redundant. China has shown that they have worked on the global stage and done counter-cyclical policy measures, while many governments and many central banks have been going with pro-cyclical monetary policy measures, which has not helped, and therefore countries have fallen into greater difficulties as a result of these old economics being touted around the world. China has adopted a much more dynamic, much more targeted type of monetary policy and fiscal policy. We see that very clearly in the numbers that our colleague shared. Similarly, in Chinese development banking and its regional banking balance sheets, you see the same type of structures coming through. So to cut a long story short, I know we are pressed for time. I'm going to make it to give you 2 more minutes penalty and then we wind up. From a key policy initiative, what are the differences was the question that was posed to me. I think there are 3 major differences. One difference is many of us went with the private sector-led growth model, whereas China went with a state-led growth model and then gradually opened it up and got the state entities to compete globally, and private sector also became part and parcel of the overall machinery of that growth story. So that's something which is very clear in what we are saying, in what we are seeing. Second point is Sri Lanka has been having policy discussions, and the policy framework has been dictated by Western-led multilateral agencies, particularly the IMF. Sri Lanka has been engaged with the IMF from 1962. It had gone to the IMF on 16 occasions with very little results to show for, whereas China didn't do that. China didn't go to any other multilateral agency, even though the economy was in a shape of transition. They continued with their policy, and the policy framework was to look at how best they could stimulate local governments and stimulate companies to compete at a global stage. And they didn't go into that full hog liberalization model, which is advocated to many of our countries by orthodox economics. So that's another key point that we find as a differentiating factor. And I mentioned this earlier, the development banking concept was a key pillar that was a miss in many of our countries. Indonesia highlighted a similar story, that banks are reluctant to lend. There is the differentiating fact that China has full control of its development, regional, agrarian, infrastructure. All these banks have a key element of centralized focus and more appetite to take on balance sheet risk, as opposed to any other commercial bank, which looks at shareholder maximization as opposed to national public maximization. So there is a fundamental difference in that particular point of how the countries have organized themselves. So those are the three points. And the last point, I think, which was raised to me, was asking me to see whether there was any taper tantrums that we could talk of in the context of quantitative easing. Sri Lanka has not ventured around that particular point very strongly, as opposed to what we're seeing happening in the US and more Western economies. Sri Lanka has not injected liquidity to stimulate the banking sector from its collapse, or to give an incentive to the banking sector to ensure to keep monetary policy rates low, to facilitate the debt restructuring process, and to ensure to keep the yield curve flat. So the taper tantrums or the quantitative easing were twofold. One was to ensure that there's adequate liquidity, and the second point was to ensure that by injecting liquidity and buying those corporate bonds, bond yields remain flat, because balance sheets were highly leveraged in the US after the 2009 collapse. So therefore, any increase in monetary policy would have killed many of the US companies, and therefore the central bank took a easier route. As opposed to injecting liquidity, they went into the quantitative easing method, and now we talk about quantitative easing as a means of stimulating the economy, which is an unorthodox approach, as opposed to injecting liquidity, because liquidity is rampant in the global economy. And that is evident by we look at the overall monetary aggregates. Money supply has increased by more than 300%, including in China, whereas inflation has continued to taper down, as opposed to what we're seeing in the last year, given the supply shocks and supply constraints. That's a one-off exogenous shock. But despite that, if you look at on average, global inflation has tapered down. That is because productivity has increased, and the relevance of money in terms of productivity has lesser bearing on the overall inflationary story, and therefore inflation continues to remain fairly soft. And I think that kind of environment, we are seeing China stand out and completely take an unorthodox approach, while cutting interest rates, where Fed and rest of European Union and UK are moving in the opposite direction, which is going to be detrimental to the global economy. Those are my observations, Pallavi. Thank you so much for the time.
Thank you very much, Kenneth. And indeed, thank you very much to all of you for very rich inputs into this session. We have, really extended the discussion. So in fact, there's not as much time for questions as I think we were hoping. But I think what does come out very clearly from some of the presentations, and indeed raises questions, is this issue of the extent to which liberalization has not been adequately managed, and as a consequence of that, one has seen the push factors in developing countries that now, of course, leave us with not only very high levels of indebtedness, but also possible consequences of tapering as interest rates increase in the US. I think for us, there are three sort of themes that come out in terms of the questions that have been sent to me on the chat. The one is the issue: to what extent can we address this very high level of debt to exports? How can we deal with that very high servicing level? Is there any solution? Has there been any stress tests undertaken by countries? And is there kind of an acknowledgement that should this tapering take place, is there a kind of a balancing act that might be done between the exchange rate and the interest rates? And what could we see coming out of the development banks going forward, particularly perhaps if they would be able to perhaps on regional development banks being able to receive SDR funding in some form that in fact could be recycled within the economy. So I've got those three questions. We have really run out of time. Can I ask everybody on the panel to really just see if they can address one of those questions in 2 minutes? I'll also draw in Stephanie Blankenberg and Professor Petros also to have 2 minutes of closing statements. So if I could perhaps begin with you, Abdul, and then we'll go around the table quickly.
According to the situation right now, especially in Indonesia, we know the situation is not really good since we are facing the Omicron spread in our country. On the other hand, we need to anticipate the debt increasing since our country is challenged by the decline of state revenue, state income. So the main point in Indonesia is how to maximize the role of domestic economy. You know that our domestic economy contributes about 80% of GDP. It means we can focus on that, but we also should take the advantage from the global economy, such as the maximize the impact increasing of the commodity price to our fiscal revenue. According to the developing banks, it means it is the situation very challenging because we don't know how the pandemic will end. But our strategy is still focused to the domestic economy and power to maintain our domestic economy, such as the purchasing power of our society.
Okay, thank you. Sorry, I'm going to stop you there.
Yes.
I'm going to go straight over to Firu. Would you like to come in?
Yes, very quickly. From the Ethiopian side, already in prior to COVID, debt sustainability was an issue. COVID and then conflict became the perfect storm. So debt suspension, etc., is not going to move the country to a sustainable level of debt. So debt restructuring is something that should be considered and is being considered. Regarding the tapering, we're not looking to the commercial creditors anytime soon. We have one, so the direct impact is, I think, would be quite limited from the debt side, but there might be other indirect impact on the macroeconomy. Over to you. Thank you.
Thanks so much, Firu. Stephanie, I'm going to bring you in here.
Okay, Penelope, thank you. I just wanted to highlight, having listened to the presentations by everybody, quite how rich and relevant this discussion is because it does bring together, and that rarely is the case, the structural issues that economies face, and that my apologies, that vary between the countries here discussed, on the one hand, and their ability to face macroeconomic shocks, so to speak. I think that's a very important lesson to be kept here. I'd love to take the discussion further, in particular Andrelem Mengitsu, of course, highlighting the approaches that to close the domestic savings gap in Ethiopia, for example, through fairly orthodox monetary policy, including the independence of the central bank and reliance on FDI. That may well be something that really matters in the case of Ethiopia, but it would matter against the background of a better understanding of structural constraints. Other structural constraints have been highlighted for Indonesia and Sri Lanka. And to me, the richness of this debate is precisely that, as is rarely the case, I can only emphasize a deeper understanding of those structural constraints with policies that, whether one likes it or not, have to confront both the need for structural transformation as well as dealing with day-to-day macroeconomic instability. Is what I find particularly interesting in this kind of context. As we know, there's no time to go through this in further detail for particular countries and perhaps also from an UNCTAD perspective more generally for our work. But I would just like to really thank you for your contributions that I think make a real contribution to our work. Thank you for that.
Thank you so much, Stephanie. Professor Petros, would you like to come in at all? You're still muted.
Can you hear me now?
Yes.
Okay. Respected webinar participants, this webinar has provided policy studies institute researchers opportunity to share their findings on Ethiopian macroeconomic challenges with researchers from Indonesia and Sri Lanka and with the international finance community. As latecomers on economic growth initiatives, Ethiopia will learn from the Chinese success story and other developing countries that are registering success, such as Indonesia and Sri Lanka. PSA will be happy to continue to learn from successful economic growth models and the kind services or provision of support from the UNCTAD initiatives like the present seminar. So I would like to thank all contributors who participated in this webinar, and also the presenters who competently articulated their findings and found the interaction rather very educational and professional. Thank you very much.
Thank you so much, Professor. I guess the time has come for us to close the session. With apologies to Kenneth and to Andrelem for not coming back to you, but you both had a chance to speak, and I know that we would very much like to continue this conversation perhaps in another forum. Just to all the participants, thank you very much for coming. Thank you for your questions. Just to warn you, as you exit, you will be guided through a series of quick survey questions asked to evaluate how you found this session. Please note that some of the questions don't apply. You will be asked about digital transformation and so on, but you will get to the questions on macroeconomics and debt. So thank you very much, and thank you for everybody who participated, and all the very best. We appreciate you being here.
Thank you, Penelope. Thank you, everybody.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Everyone.
Thank you. Bye.
Thank you, Penelope. Bye-bye.
Thank you. Bye-bye.
Thank you.
Second.